Let's pick gain, any of the gain and any of the pain. It doesn't matter. The difference between pain and gain is that one spikes upward, one spikes downward. Pain, pain spikes downward. Gain spikes upward after certain number of candles. That's the difference. And the higher the number, you see there's pain X99, the one I just clicked now. There's pain 800, sorry, right? And
Yes,
then
sir.
see there's pain 1200. The same thing you have in gain. You have gain 800, gain X 800, gain X 99, and then you have gain X 1200. You see that? It's like I've not added the gain X 1200. Okay, it's like I've not added that one. Simple. All you need to do is come to this cross, this point I just click, and you just type in gain X. You see, I didn't add it. You saw I just add it by clicking here. That's all. There are other gain and pain. The reason why we don't choose other gain and pain like 400, 600 is for the reason that they are very volatile. They spike more frequently. We don't want to pick something that spikes too frequently like that, at least for beginners. But for advanced classes, you can actually do that. So I told you that the fastest way to know the difference
So
between these
sorry, sir.
spikes. Not
So sorry to cut you short.
okay.
Sorry. Which of the gains do you say spikes so volatile, like spikes so often?
The lower numbers of the gain and pain, like from 400, 600, 400 and 600 in gain and in pain, both of them.
Okay. All right. Thank you.
The higher the number, the lower the frequency of spike.
Okay.
So that's why we decided for this class, by the time you have mastered trading, you can choose whichever one you want to go on with. You might have known how to trade them. But it's not about competing on knowing how to trade. We are here to make money. Our aim is to make money, right? Okay. Let me just pick
Okay.
randomly. Let me pick randomly. Pain X 1200. So I pick it. Then I showed us how to check time frame. You can either come to this point. You see where I click and it shows you a lot of time frame, which is a long process. Just click on the screen and just look at M1. It's 1 minute. Do you see that as usual, I have to pick our tool, and this is the tool. So do you see that a spike downward? That is a spike downward. This is for pain X. Pain, just know that pain, downward spike. Anytime you have pain, the spike is downward. Then, and the it counts candles upward. It counts its candle upward, just the way you are seeing here, just the way you are seeing here. So it counts the candle upward while the spike is downward. Then you go to gain X. I showed us this is a shortcut of doing it. If you don't want to come here, you come here. What I just showed us was pain. I just come to gain again. I pick any gain. Let me say I just pick this one. Do you see the difference? Now, to show us the difference across screen, I will have to split this screen into two. I showed us how to split the screen. Click and hold. No, just click like this, and then press this icon here. This is the icon you click. Then I say another window. Instead of allowing gain, I use pain. The one up is gain, the one down, pain. And I choose 1 minute. So do you see the difference? And I'll pick my tool, my illustration, my arrow tool for illustration. So do you see that the spike, you see the spike is upward, bullish candle, bullish candle, bullish candle. You can see they are bullish candle. They are showing bullish candle. The bullish candle, you always have a spike of bullish candle for gain. While when you come for pain, let me also pick my tool here. You see? the spike is downward. Do you see the difference? Emmanuel, do you see the difference?
Yes, sir.
That's the difference between them. Now, apart from the fact that gain spikes upward, gain spikes downward, also know that the frequency of spike is proportional to the number of the synthetic. What do I mean? I told us earlier, the lower the number, the more the frequency, the lower the number. I mean, after the X, the number you see after whether gain X, open X, the number you see tells you how frequent will be the spike. Now, apart from the fact that the number gain pen X 1200 will spike less compared to pen X 800, and pen X on X pen X 800, sorry, pen X 1200 will spike less compared to pen X 1000. Sorry, I don't know why. This pen X will spend less, will spike less compared to pen X99, and pen X99 will spike less compared to pen X800. Under the category of pen X, you find out that 1200 will spike less compared to 800, compared to 999, then compared to 800. The same thing with gain. In the category of gain X 1200, which is here, last year, will spike less compared to gain X99, which is here, and gain X99 will spike less compared to gain X800. Having said that, the directional bias, what do we mean by directional bias? Markets down or market up. The direction for the day. And I showed us, permit me to cancel this. I need to take this out. I want to have a single screen. So, if you might find that you are in gain X 1200, and then you are seeing spikes like this. But he said there will be less frequent spikes. Are these not the spikes I'm seeing? I'm seeing many spikes now. But he said there will be less spikes. Yes. Why won't there be more spikes? If the directional bias for the day is upward, that means that you see a lot of spikes, and the spikes will be very long spikes. That means that the directional bias for gain X for that day is upward. Meanwhile, notice that, remember that gain X spikes upward, and the direction for the market that day is upward. You have more frequent spikes. So that day, what you should be hunting for is spikes. What you should be looking for is opportunity to buy spikes. These are spikes. This one is spike. This is spike. This is spike. Then these ones are called candles. We count them. So you find out that you now begin to count them. You don't have to begin to count them. I told you last yesterday, just follow the moment you are counting candles, which is the higher moving average, which is the 50, right? Just jump out. We'll just come out when you have made the profit you think you are comfortable with. But now, when the market is on a spiking day, and then it spikes, and you are waiting that, okay, it will spike down, they'll tell you, wait, it will clear, and keep on spiking. This is what clears people account. Imagine you are counting candle on this. This is gain X, which normally always spikes upward. And it happens that for that day, the market directional bias is upward. You have more frequent spikes. Now, even if the directional bias for that day is going to be downward market, that means we will have more candles and less spikes. That will see the spikes, but it will be more frequent. So for us to confirm if what I'm saying is true, just click here, and then just the way I explained to us, we click our day, our daily time frame. We click on our daily time frame. What is the normal procedure? We pick the high and the low of the day. So we pick our tools, and then we pick these two and we drop. We put our blue candle. You can give it any color you want. We put our blue candle here. At the end of that week, the week I told us is the last line, the line you see either above or below a candle. In case some of us forget, we should know what is a wick. This line, I sit on this line color. This this is a wick, and this line underneath this body, this is a wick. This is a wick. This is a wick. We should know what is a wick by now. I have pressed on that over and over. This is a wick. Every of this candle has a wick. The wick should be up or down, depending whether it is bearish or bullish. So we have picked the top, the bottom of the day, and then let's pick the top. I don't have to come here. All I need to do is just copy, but I decided to just go and pick in case some people want to always, and I change the color and I save. So what have I done? I'm trying to get the high of yesterday and the low of yesterday. So the red candle, the red line, vertical line that cut across the screen, we call it the resistance, and the blue candle that cut below across the screen below, we call it the support. Now, why did we do that? We want to know the directional bias for the day. Now, if you look at this candle that we decided to pick the high and the low of, what candle are we taking the high? Let me expand my screen. So these two can be picking it. So I have to pick another one. This is the candle we are picking the high and low. This candle, this bullish candle, this candle. That is the candle we are picking the high and the low of. This candle, this arrow is pointing at. So we pick the high. Why? Because we are on a daily time frame. We pick the daily time frame. This is the daily time frame. So we pick this, and then we pick the high and the low of the candle. Is the previous day. That means today is Tuesday. This candle is telling you that yesterday's candle was Tuesday, and it's telling you the market went up. Now, when you take this candle up and down, you look at the candle that formed before it. It was this candle. It means that this candle closed above this candle. This candle took the top and the bottom. It has its top up here and the bottom here. Now, the candle that came before it, look at it. That means that this candle, yesterday's candle, closed above Sunday candle. This candle is Sunday. This is Monday. This one is today's candle. So we are taking this high and low of this one, and we look at, okay, what happened? Why did this one close upward? Because it closed above this one. So what do? We automatically suspect and expect today's candle to close above this candle. And now, what do we do next? We reduce it to time frame. I told us time frame alignment yesterday. When we are looking at daily, you can go on 4 hours, but daily you go on 1 hour. How to reduce? Allow me to reduce screen to zoom in. Now, do you see what is happening here? Before I zoom in on 1 hour, let me put the daily separator, which I remove because I don't always use it. I'm only using this separator for this class because I have gone past this level. But for the purpose of this class, I have to put it so that I can explain very well, so that I can understand what I'm teaching. So this, just a moment, please. I told us this is the daily separator. This dotted line that cut from top to bottom. So I cut, this is the previous day, and then to this point. So that is yesterday. The yesterday started from this point and ended here. So that is previous, and we'll pick the high and the low of it. Yes, we pick the high. So where is the low? right, sorry.
Excuse me, sir.
Hello, good evening.
Good evening, sir. Please,
You're
sir, I'm
welcome.
unable to view the screen. I can't see your screen.
Are you the only one that's not seeing? Everybody seeing my screen?
Yes, we can see your
Everybody
screen.
seeing my
Yes, we can see your screen, sir.
So I think it's from your own side, Naomi. You're the only one that's not. You're the only one that's not seeing my screen. I don't know what is the problem. Maybe it's your network or something. I don't know. I don't know how to help you with that. But I think it's from your own side. Maybe just log out and log in again. Thank you. So I drag this way so that I can actually see previous day high and previous day low. Okay, I think what I did, I went on 2 days backward. Okay. I got yesterday's high and I didn't get yesterday's low. So I need to drag it. That's why when you do the daily stuff, always come back to 1 hour and put the day separators so that you can actually gauge if your daily markings of support and resistance is accurate. So this one too, I need to bring it on top of this line that does not, these two lines that don't have a wick on top. They immediately formed after the vertical line up. Okay. Now you see I've gotten it. So if I go back to my daily to confirm if I'm right, okay, I'm right. Something is wrong here. This is not right. This is not right. Sorry, a moment. The daily separator, what's wrong with empty distance today? Well, let's just stick to the daily time frame because I don't know. When you go on 1 hour, it's giving me something off. All right, the daily separator on 1 hour is giving us the accurate reading for the separators. On the daily, it's giving me something else. So let's just use the 1 hour, and then we have gotten the separator. The separator helped us to get the high of the day and the low of the day. Now, I remember yesterday I taught us why I was emphasizing and talking about why I kept on talking about candle wick. I spoke about engulfing, bearish engulfing pattern and the bullish engulfing pattern. And I told us how it is formed and why we should take it serious when that happens. Then I told us about when a candle closes below the resistance, just like this one that I'm pointing at now. This particular candle here, this arrow is pointing at. You see this candle went up above the resistance of yesterday's high and then closed below it. Then look at this bearish candle, this gray candle. It's forming well more of like a bearish engulfing pattern here. Look at this. Where's the bearish in this candle and this candle? And telling that this bearish candle closed below this candle. This is how the market came down. That is our number one confirmation, which is more faster. I told us yesterday, candle price action acts more faster before moving average. Now we have gotten a confirmation from here to enter this trade. But look at when you are getting the confirmation on moving average at this point, where there is a cross. Remember yesterday somebody was asking a question that what is a signal? How do you know when to enter using moving average? I told you when the faster moving average, which is 9, this purple color is 9, and the one which is gold is 13. So when the 9 crosses the 13 from top and they are both facing bottom, just know that the market is changing direction. So we got our first confirmation here, the market is coming down, and then we wait for the candle that break both the moving average, this particular candle. This particular candle is what break the two moving average, and points down. So we have gotten our second confirmation. The third confirmation is at this point when the two moving average crosses and then they open. Look at the gap between them. The crosses and give a gap between them. That is your third confirmation. And then look at when the moving relative strength index is telling you to enter the market. This area point is telling you to enter the market at this point. So by the time you have gotten these confirmations to enter, the moving average has even gone down. It's telling you that the market is over. Sorry, it's telling you the market is oversold. I tell you, you finish your analysis from the top, from the price in the price window. This is your price window. Everything we do here is a price window, and anything that happens here is the indicator window, and is the one that comes last, because the real driver of the market is price. What happens in this place, this is what moves the market. What happens below here is just additional confirmation. So basically, at the level at which I trade, I hardly use relative strength index because it's a lagging indicator. But for the purpose of this class, you can just use it to be learning. There's nothing wrong using relative strength index. All is telling you that at this point where I'm pointing here, the relative strength index, where the arrow is pointing at, that's where you should have entered. And then that means that you should have entered when the relative strength index was here and this candle formed. Even the relative index, when it's telling you to enter, you don't enter, you wait for scenario like this to happen. A candle that breaks the resistance and then return back and leave a wick that cut across the previous day resistance, just like this candle, this arrow is pointing at it, just like what this candle did. So the simple procedure on the day when you come to your chart, first thing you are supposed to do first is to just go to your daily. Normally, I don't know what's wrong with the MT5 mobile device. Throughout today, it has been problematic even using it, because first, as we did yesterday, you click on the daily, and if you look at the daily, our daily is telling us that the low is this bullish candle. It's telling us that it is this bullish candle. It's telling us this bullish candle. This bullish candle gives us the high and the low of yesterday, but it is not true, because the moment you take the low by this, which is what you're supposed to do, and then go back and click and then go to 1 hour using this separator, you find out that you are not seeing the blue candle. It's actually showing you the low of Sunday, not the low of Monday. This is the low of Monday. This particular place, this is the low of Monday, because this vertical line that cut from top to bottom separate just like you have it here. So it starts from here. So it starts from here and ends here. So this is every day. So if you scroll, it tells you that the candle began, and you find out that the ranges of the candle were pointing downward. So contrary to what the day time frame is showing us, the day time frame is telling us to say bullish move. But when we come to our 1 hour, you find out that the market actually was coming down. It was a bearish candle. So which one do you use? I would advise that always come to 1 hour. In case you find this kind of situation, just come to your 1 hour. 1 hour and use the separators. And then when you use the separators, just pick your support and just bring it to the lowest of the candle. So you have gotten the high and the low of the day. So that is the first thing you do. Yeah, that is the normal sequence of trading. First, go to 1 hour daily, know the direction. Was it a bullish candle of the previous day? We have now. Come to 1 hour and know the directional bias previous day. And the directional bias of the previous day. Sorry, somebody is trying to call. I don't know. Just a moment, please. Okay. Sorry for that little interruption. I just had a call. I just had to answer that call. So let me go back to our screen. Sorry for that. So I was trying to explain our directional bias of the previous day. The directional bias for the previous day started from this resistance and came downward. Then before the new day started, we found out that the market started going upward, just the way we have here. We found out the market started going upward. So by the time the market started a new day, the market started coming downward again, just like what happened yesterday. So why did the market float downward? We found out that when the market got to yesterday's resistance, which this candle pierced it. This candle pierced it. How did it pierce it? Look at the wick. This wick. That's what we call the wick. This wick pierced yesterday's resistance, which is this red line that crosses from left to right of the screen. So when we see something like this, and this candle, and then the body of this candle did not close above the red line, but close below this line. The body and the wick, this is how we use the body and the wick, tells us the story. The wick tells you a story. That is why the wick is very important. The length of the wick also matters, but what matters to us is the body. Was the body outside or inside the resistance? It's inside the resistance. Now, that is not enough. Do we have another candle like this, bullish candle, and then an engulfing pattern? I told us engulfing pattern is bearish engulfing pattern when you have a short bullish candle like this one, and then a long bearish candle like this one. Particularly at a resistance. Where is our resistance? Our resistance is this red line. This is what we call resistance of previous day. And we are finding this one candle, this candle that this one confirmation, the combination of this pair is another confirmation. This is telling a selling scenario. So with this scenario, is confirming the fact that our RSI is always telling us that we are already overbought. So even at this point, that this candle have printed this 1, 2, 3 candle. This candle in itself was the first confirmation that market is going to come down because the body is inside the yesterday's range. We have this small bullish candle and then this long giving us a bearish pattern of engulfing pattern. Boom, you just enter from this candle. You just enter from this candle. Now, this is gain X. And we remember, gain X, we say gain X spikes what? Upward. Is that? I told us the only way you can know, see, gain X spikes upward. So let's come back to our 1 hour time frame. So we know that gain X spikes upward. So on this day, you have a lot of counting candles. In this day, your spikes should not frighten you. If you enter at a good point, when you see a spike, you should not be afraid. Why? Because the candle is going to count very, very well. You keep on counting, but the moment you reach 50 moving average on the wall, begin to jump out of the market. Because if it breaks and come down, this particular candle now can frighten you. Because if you enter at the end of this bearish candle, this arrow is pointing at. If you enter at the end, which is the low of this candle, the market begins to spike upward. This is the kind of spike like I can just finish your account if you don't enter well. You now say, what is happening? Then later on, you now see the market begin to count downward, and even come below where you enter, which is this point. But because you entered at the very wrong plan, this point of entry is no man land. Your entry should be either from this point, resistance, or from this point, support. These are the two places you should enter from. And then if you enter from here, you can see how the market went. Now, if you want to know whether I'm right or not, let's go on 1 minute that most people trade, go on 1 minute, you find out that you have more. Do you see that the market? Do you see that the candles count more longer? Do you see the way this one counted? Now let's see where it started. At least this is 1 minute, so we have to scroll backward very well. Do you see that candle that we saw the week upward? This is where in 1 minute, this is what happened. So when you see this spike that happened after you have gone to 1 hour and have gotten their up and low of previous day, if you choose, you can come to 1 minute. 1 minute, this candle now, there is no way this candle will last a week. Sorry, I need to pick my tool. I'll have to pick another tool. So we're taking a trade because I just want to establish this. We'll be taking a trade, right? So now look at this. There's no way it will tell you this candle on 1 minute does not show you weak. It just show you body. It's not enough for you to come to 1 minute. I want to do analysis to pick a trade. To me, any analysis you do on 1 minute, you're just gambling. So you have to do the normal thing. Come to 1 hour, understand what is happening. Come to 1 hour, know what is happening. So if you go when this candle has formed, after this candle has formed, you now know that the market is going to come down. You now go on 1 minute if you want to trade 1 minute. And you go to where the market crossed the resistance, which is okay. This point. You see? This point, this scenario back into the resistance. Now, even if you choose that, okay, I will not wait for that candle to finish forming. The moment this candle form into this point and enter into the resistance, you can start counting. Now, do you see it aligns with the moving average where it has crossed here? The moving average has crossed here. Then the candle is counting. But now, if you look at the relative strength index is already telling you that the market is oversold. It will spike any moment. But it's not true. You really know based on your analysis, the market is going to count downward. And look at how it's going. Look at how it keeps on going. Sorry, let me delete this. Look at how so even when it spiked, do you see that the spike didn't go back to the resistance? Why? Because today the bias is bearish. Because the bias is bearish. So even when this thing spiked, you see, it didn't go back all the way to the resistance. We expect the market to keep going. Even though when this spike happened again, there were spikes here. Look at, I think almost 2 spikes. Still, it didn't touch the resistance. It kept on counting downward, kept going. So you see, you have more candles than the spikes. The candle, when it's going to run, it runs a lot before it spikes. So when you enter this market at a very good analysis, you do your analysis probably very well by knowing the directional bias for the day. Spikes does not even frighten you. You just enter the market knowing fully that you already know the direction of the market. And I told us that don't stay too long in the market. If you have $50 and you have made $5 for the day, that means you have made 10% of your money. And imagine the next day you make another 10%. Another day you make 10%. Within 1 week, within 5 days, you have made 50% of your money, $25 within a week. So, and I tell you that if you need to count those candles, you won't even get to this 50 moving average. You would have made more than $5, even $10, $15. So, but if you go on 1 minute to trade, no. So, as it stands now, when I go on 1 hour, where is the market? Can I pick trade on this market at the moment? No. Why? Because I'm at no man's land. The only reason I may take this market is because it's at 50 moving average. Look at the 50 moving average. And the shape of the moving average matters. The moving average is looking like a straight line. It's not pointing downward. It's not pointing upward. So it's going to be zigzag markets here. You will just lose money. It will just be playing with your mind and your emotion. It will go up, come down, go up, come down. We only enter trade when we see the directional bias, the relative strength index aligns with our directional bias. 1, 2, we have seen a cross. 3, so you move. But if you must enter this trade, then maybe you go on a lower time frame, let's say 15 minutes. Is the 15 minutes giving you a sign? Yes. The 15 minutes is saying you can actually enter a trade. How? But mind you, our directional bias is bearish. So entering a bullish trade is like you are hunting for spikes. And the moment you are hunting for spikes and the spike did not happen, you'll be losing money. Why? Because the market will keep on counting and counting too long before it spikes. So you keep on waiting for spike, the spike does not happen. The candle is milking candle. The candle even spikes, not even spikes back to where you expected it to happen. So for this market, look at it, just spike downward. We're in gain, and the spike, no, spike is upward. So I don't know why. Maybe maybe it's my network. It didn't print well. It's my network, so the thing just dropped. But it does not spike downward. So today candle is counting downward. So if you have said, okay, we have gotten a cross here, one, and then the candle have broken, we have a small bearish candle here and a long bullish candle. This is a bullish engulfing pattern. And you say, okay, let me buy after this bullish engulfing pattern because I'm supposed to enter from here. This is what happened. The candle kept on counting. If you start counting, where is it heading to? My brethren, this market is heading all the way to where this arrow is pointing. That's where it's headed to. The only reason it will not get there is because of this engulfing pattern here. And I won't talk about it for today. Because if you draw a line from this engulfing pattern all the way to this point, it's telling you that the market is about to reverse upward. Even though today market is counting candle, from this point, the market will begin to spike. Why is it spiking? Not for today's class. We're talking about that, but just always look at engulfing pattern. Wherever you see engulfing pattern, think of market stopping there or market starting from there. If market started from engulfing pattern, it will end at an engulfing pattern. This is an engulfing pattern that happened here. This is another engulfing pattern from the previous day. You draw a line. Always draw a line from one engulfing pattern. So with this now, I can tell you I am good to enter. But I will not enter because I'm still far from this engulfing pattern. I'm supposed to have entered from this engulfing pattern. I'm still far from it. And because of this class, I don't want to go into this. So you don't force a trade. Now look at the trade we did yesterday. I told us the pen X 800. How many of us remember the pen X 800 that we did analysis yesterday? Hello? The pen X 800 that I told us that is going to be a bearish market. Can you hear me? Can you guys hear me? Hello?
Yes, we can hear you. Some of us were not here yesterday, so I think that's why the silence is there.
We can hear you, sir. We're thinking about PPX instead.
Okay, but you guys are hearing me, right? I just want to know if you guys are hearing.
Yes,
My
we're
voice is
hearing
loud
loud
and
and
clear.
clear.
All right.
Yes, can hear you.
Okay. Now, pen S800, if you follow the lectures we did yesterday, it was almost the last lectures we had. And I told us that this market, after this analysis, I told us that look at the engulfing pattern, and I drew a line, and I left it since yesterday to today. And I told us that the market will go all the way, and I drew a line. Here is a line. Look at it here. This is an engulfing pattern here. This bearish candle and this candle, an engulfing pattern, and it was closer to previous day high and low. This was previous day high and low. So an engulfing pattern happened from yesterday's resistance. So I told us that this market is going to come down. So we went on 1 hour and I drew a line. This was the line. And I told us that the market was going to go all the way. I entered a trade. I entered a trade from here. I entered a trade from here, and I told us that if you get to this point, and the market will now crash. And if you remember my account balance as of that yesterday, my account balance was $98. You can see it's now $1,007. Now, to confirm that, we go to history. This is PenX. This was the trade I entered. I made $18. Now, you click on it to confirm whether I'm saying the truth. You check the trade. How do you check the trade? The chart will prove to you whether I'm lying or not. You just click on the screen, click on this icon, and I say my trade history. To show me the trade history on the screen, I reduce this to 15 minutes. You will now see where I enter and when I came out. Do you see? Well, let me reduce this to 5 minutes. You have to scroll backward. You see the trade I placed. You can see lines showing you because I entered many trades at the same time. So it's showing where I bought and where I came out. I didn't even stay long. This is where I came out. I entered some here. I entered some here. I entered some here. Wherever you see this blue arrow, is where I entered from. And all of them, I sold this one here, this one, and this one. I sold it here. That's why I see this red arrow pointing down. The red arrow tells you where you sell. The blue arrow tells you where you bought. So this is history of what has happened. So how do you get it? You come here, you click on this menu, and then you click trade history. This is the trade history that shows what has happened on the chart. So I don't always leave it so that I always like my charts to look clean so that it will interrupt with my analysis. So I showed us, let me go back one. I showed us that it will get to that because our directional bias for PNX 800 is bearish. So even though the market is doing like zigzag, up and down, but it is heading downward. If you go on 1 minute, you find out that you have a lot of spikes downward. Even though there are movement upward, but you find out that the spikes are more longer. Look at them. Look at them. You have a lot of spikes. You just get small candles and then spike. Look at the kind of spike. These spikes, you may see them looking like small, but during trade, they are heavy spikes. They are heavy spikes. Look at almost 4, 1, 2, 3, 4 spikes. Because the market is a bearish candle and PenX normally spikes downward. So if the directional bias for that day is downward market for a PenX, you will see a lot of spikes upward. Please, any question? Let's look PenX 99. Are you guys hearing me, please?
Yes, sir, loud and
Yes.
clear.
Yeah.
All right.
Yes, sir.
Now, I told us our normal procedure when you come to the screen, what do you look for? First, you look for what? The high and the low of the previous day. And the high and the low of the previous day will go on normally daily. Let's try it maybe on this one, we will get it right. You click on the daily time frame. You pick the high and the top and the bottom of the previous day by taking this to horizontal line. You take the top, you copy it, you take the bottom, you give it a color that shows the difference between support and resistance. We get our support and resistance. Then you come back to 1 hour. Let's see whether it works out with this. So yeah, it's like this one worked. I don't know why the other PNX 99, DNX 99 didn't work. DNX 1200 didn't work. So this one we are right. So what did we do? When you come to your chart, first you go on daily, then you pick the candle the previous day. That's the candle before the current candle. You take the top and the bottom. Then you come to 1 hour to confirm if you have actually gotten the top and the bottom by looking at the vertical line that cut across the screen, the two vertical lines. Then when you have gotten that, you now look, okay, let's see what happens. Now, what happens today? The market came down. Now, instead of this candle forming the reverse up here, it formed downward. cutting across the moving average. And remember, I told us that moving average can also serve as support and resistance. So this moving average became the support for this week of this bullish candle. Look at the week. Instead of this body to close below the moving average, it closed above the moving average, telling you that this is a buy opportunity. But we won't rush to do that. We are more interested. Now, how do we even know what the directional bias? On the daily, we find out that the candle, the previous day candle was a bullish candle. This one. Whatever happened the previous day gives you a clue of what will happen today. If the previous day candle is a bullish candle that closes above its predecessor, which is this one. Which is this one? This bullish candle closes above this one. It's telling you that the current day candle will also go upward. So based on this bullish candle, we are seeing that closes above this bearish candle. We just know that this particular candle, you always compare yesterday's candle with the candle that formed before it. I repeat myself. You always look at yesterday's candle, you compare it with the candle that formed before it. So you always look 2 days backward. So if I'm going to trade today, I will say this candle today, what happened to this candle? This candle is bullish, because it closed above this. So automatically, I'm expecting this one to go up. How far will it go? Well, we'll be learning that tomorrow. Our aim is to be making as little money based on percentage that we can make. So we just know that our directional bias is going to be bullish, meaning that even this resistance will not stop this movement. That's what it means. Even though we are saying that we are close to this resistance, for the fact that this twin candle has given us a directional bias for today, we know that we are going upward. So we reduce to 1 hour and we look at what happened. Well, you see, the resistance could not hold. The resistance of the previous day could not hold today's candle. And that's what happened. You see, this candle went up, closed above. So what will I do? The candle did not close below it, neither there is a wick. Even though there was a wick, but the body of this candle formed above. I wait for a very good full blown like this. I just enter a buy. How far will I go? Even this one now is buying. Now, what is the signal? You say, but moving average has not given the signal. What signal do you need? The signal has happened since the previous day. Look at it. It happened here. And you can see the space between the two moving average is it's constant. It's moving up. And both of it have crossed the resistance of yesterday. Good. But let me tell you, another way to trade such kind of, you have to be very conservative. When the market crosses like this, wait for it to come back and form something like, look at this candle. Look at this candle. Normally, imagine this candle form and leave its wick below the resistance and the body upward. You just buy. Now, we can also buy because we are seeing the fact that this candle have formed here. You're supposed to have entered here. And then we are seeing them leaving wick. The wicks are falling below the moving average, the two moving average. We see this candle forming here, giving us an idea that this market is going to go up. Our relative strength index, even though it's above the line, because we are entering late here, is telling us that it's opportunity. We can actually wait, or we can still buy and jump out when it gets the relative strength index, which is 90. So this is not a really high probable trade, because where you should have entered is where this week happened. This week, the week of this candle, that cut across the two moving average and is pointing upward, and the body is above. So you have 4 types of support and resistance. You have the one of the previous day resistance, and then previous day support, right? You also can use 50 moving average, 30 moving average, and 9 moving average as support and resistance, depending. For the moving average, they are mobile, flexible support and resistance. It is the candle that interprets it. We already say that they are pointing upward. The faster moving average, which is 9, is already pointing upwards, and then the slower one, which is 13, they're all pointing upward, and we have this candle already leaving its wick cutting across the both. That means what this candle just did, this candle here, just converted the two moving average into support. The price of the candle will always convert it, confirming the directional bias of the moving average. So you should have entered from here. And then if you have entered from here, come out at the resistance. Don't even say the market will keep on going. We know the directional bias is going to break it. But in most cases, they will react here and then maybe come back to this 50 moving average and before going up. So if you have entered from this point and the market begins to approach this point, this red line, which is the previous day resistance, exit the market. Wait, when something like this happen again, you can now enter. But I will always advise it is better this candle here had formed at this point and the wick is below and the body is above. Then you enter. So if for the purpose of teaching us about money management, I will still enter this trade. Since why am I entering this trade? I'm entering this trade because I know the directional bias on the daily time frame is up. So I can still enter. The problem with this entry is that I'm entering late. So if I'm entering late, where am I supposed to put my support, my stop loss? So if I enter this trade, I'm supposed to enter buy, and I click buy at the market price. I'm supposed to take I click on my stop loss. My stop loss is supposed to be here because this previous day resistance is now support because price, the candles are broke above it. And then my support, I can put it high. But now look at the amount I stand to get. The stop loss is telling me that if the market comes against me, I will be losing $21.62. And then if I'm making profit, I'm making $16.62. What businessman does that? Meaning that you are reaching too much to get little. No. So since I'm entering at a very wrong place, the moving average also is your support right now. I will move it just slightly below the lowest candle, below the moving average. You cannot see that my stop loss now is 8.96 and my take profit is almost twice my stop loss. Now, this is not a very good entry in terms of profit, taking a high probable trade. So if I place this trade, now I can now watch, am I in profit? I've made 24 cents. Now, looking at the fact that I didn't enter at the very good timing. Now, you're not even supposed to enter at 1 hour. You can go on 15 minutes or 5 minutes. Why? Because if you go on a lower time frame, you will see a better place to put your stop loss. Now, look at my stop loss. Look at this moving average. I bring it below the candle that cut below the moving average because it returned. The candles returned back. I just move it to this point. Now, this is a high risk trade, but are you right? Yes. In some cases, because we already know the directional bias of the market is upward, I won't bring my stop loss here. I'll put my stop loss below because it can come down, take you out, and still continue in the direction that you know the market is going to go. So why should you go too close to the market to take you out? Stay away from it. Now, I am risking $9.46. No problem, no wahala. What am I supposed to do? I will say, okay, I will go to higher time frame. I will look for a better profit. I will leave it where it is. Why? Because on the daily time frame, I know the market is going to go up. And if I choose, I've made 56 cents. Maybe I want to just make $1. When it gets to $1, I jump out. So this trade, I'm telling you, is not just for demo. This is a trade. If you understand what I just did now, it's a trade that you can place on your live account. If you have good capital, you can place this trade. But I just explained to us the money management, how to set your stop loss and your take profits. It's not a very good trade, but it's also a trade that's going to go upward. So if you don't use stop loss, why? Because even this stop loss I put, why? Because the candle is counting upward, no problem. If I put a stop loss, if the market spikes downward, it will not say I'm risking $9 and then stop at $9. If the market spikes down and stop at $13, that is where it will take me up. I will see minus $13. Even though I'm saying if you spike downward, I will see minus $9.6. But if the market spikes downward, because this pain S spikes downward, where the spikes end, that's where the stop loss is. It does not respect stop loss. Stop loss is only respected when I am counting, I put the stop loss above, and the counting candle goes and meets me where the stop loss is. Wherever I am risking, if it is even $1, it is $1 stop loss. So stop loss, you don't put stop loss in the direction of a spike, whether pain or gain. You don't put stop loss in the direction of a spike. This stop loss now is irrelevant. Why? Because the market will spike downward and it will not respect my spike. If this market spike to where the stop loss is, it will even respect it. If it goes below my stop loss, this stop loss I'm putting $9, but if it goes below it and shows $10, I will see minus $10. One spike, I will see minus $10. These are the reasons why people lose money. So, but if you understand the directional bias, you are not scared because you know that no matter how this market spike, it will continue upward. So that is why we advise that you have good capital to start this business. And if you don't have that enough capital, I advise you stick to flip, which is flip X1, which you don't experience. What Syntech was that paying? Is it paying
Payment.
800? Oh, 99.
Yes, sir.
You see, we're already in profit. So one thing I didn't show us is that you can enter several times, right? You can enter several times. So if that candle I spoke about, look at the color of the candle.
The color is
What
blue,
color is
sir.
it? Good, that's bullish candle. And you see the direction is pointing. It's pointing upward.
Yes, sir.
The body of the candle formed above the moving average, and you can see the color
Yes,
is
sir.
bullish. So you give colors to it so that you can always know. The candles cannot have three colors. It can only be two colors. The one that comes down and the one that goes up. So there's no confusion as to what candle is it. You already know that this is a bullish candle. And then another name for this kind of candle, because of this shape, maybe that's the question you're asking, is called hammer.
Thank you, sir. That's
You
what
see,
I'm asking.
yeah, it's called hammer. They always signify reversal in the market. When you see it, there are different candles that indicate when the reversal is about to happen. Engulfing pattern, morning stars, that is bullish and bearish engulfing pattern. You have crosses. You have many names for it. I don't bother myself about it. What I only bother myself about the ones that will make me money, the engulfing pattern, and then this one. Now, why I don't always use the hammer is that at times it can be very deceptive. You can still see this, and the market will still come down. Particularly if the directional bias for today is bearish, even though you are seeing this candle, this hammer, the market will still come down. The movement will just go up the resistance level, that red line, and afterward, it will just come down to maybe this point and break downward. So this is called hammer. So in case you want to trade simple, this is also hammer. When you see hammer at this point or at a resistance level, this resistance, or at the support level down here, that means that just the way it was formed here, it will form like that here. It will be pointing upward, and the body will close upward and the wick below. When you see something like that, fine. So while we take it serious because it's happening at a moving average, if it was happening here, fine. If it's happening here, fine. This hammer is called hammer. And then we use hammer or we use engulfing pattern.
Thank you, sir.
Thank you. So for those of us that like counting candles, so if you are counting, you cannot say that how many candles you have count. If you are counting candles now, you see that we have counted from where we enter 1, 2, 3. Where we enter is 1, 2, 3, 4, 5, 6, 7, 8, 9. We have gotten 10 candles, which is enough for us to jump out. We have made $2.37. But what I'm teaching us is not about counting candles. It's not about hitting target. But because if you are using small money, you just say, fine, I'm good to go. So imagine this trade I just closed. This trade I just closed $2.41. This one, $2.41. Imagine I enter 5 of it, but I've just made $10 while we are talking, just in less than 10 minutes. Or maybe you guys don't understand what I'm saying. Okay, let me just take this risk. Let me enter like 1, 2, 3, 4, 5. Now, this is, I just entered this market. I don't, because if a spike happens here, it will respect my stop loss. So there's no point putting stop loss. If I put stop loss $3 now or $4, it will respect $4. If the spike stops at $10, it will take out $10 from my account. So see how many times I've entered. I've entered 1, 2, 3, 4, 5. Do you see the way it has just done? So my aim is probably if I want to cut five candles. So I just wait for 5 candles. Why am I taking this risk? Because I know that the directional bias is up. So I can enter maybe 2 times or 3 times, 4 times. So for the same time that you made $2.4, in the same time, somebody that understands directional bias, people that have entered the same time, the market do not spike. You find out that you're making $2.4, somebody else just made $15 because he entered several times and allow it. Why? Because he understood this directional bias. And coupled with the fact that probably he has very large account, maybe up to $100, so he can afford to do this. So even when the market spikes, whether it is 1 time or 2 times, he's not scared. Now, just as I explained to us, this is a wrong place of entering this market. You are supposed to have entered from this point, where this resistance has become our support. Because when the resistance is breached, where there was resistance breached, it was breached at this point. It was breached at this point. And the candles all close above the resistance. Now, this is the reason why we always speak previous day high, previous day low. So because I'm entering at a very wrong place, you don't stay too long in the market. You jump out. Now, I just entered to just give us an example. I can enter to confirm to you that spike downward does not respect stop loss. Let's enter just single market buy and then decide to put stop loss. Let's go on 1 minute time frame. We've entered here. Let's put a stop loss. Let's say we want to reach $2, right? And then take profit. Let's say we want to make $4. We allow it. If this market spikes, you will see how much it will take out of the market. If it spikes from this point, you will see how much it takes. So you don't have to stay on one pair. You can also check other pairs that gives you good entry by going on daily. Any other question, please? Like this pen X800, the directional bias is downward. I told us yesterday, it's going to come down all the way to this support. This is support. Mind you, I told us that candles can also bring support apart from yesterday's high and yesterday's low. I can also go on daily and pick the low of a range of candles and the high of the range of candles. We'll be talking about that maybe tomorrow or next. Apart from previous day